Differentiating Islamic banking and conventional banking in Malaysia. Introduction. Hello, everyone. Today we're going to delve into a fascinating topic: the differences between Islamic banking and conventional banking, with a special focus on Malaysia. Imagine you have a piggy bank for your savings. How would you feel if the money you save there is used to help others or contribute to societal well-being? That's one way to think about Islamic banking. Let's break it down into 3 parts for easier understanding. 1. The basic principles of Islamic and conventional banking. 2. How these principles promote ethics and professionalism. 3. Real-world examples from Malaysian banking practices. Fundamental differences. Islamic banking and conventional banking operate on very different principles, much like 2 distinct games with unique rules. 1. Principles of Islamic banking. Islamic banking is guided by Sharia law, a framework of Islamic rules and ethical guidelines. Interest, riba, is strictly prohibited. Instead, Islamic banking operates on profit-sharing or leasing agreements to ensure fairness. Investments in activities considered harmful to society, such as gambling, alcohol production, or unethical trade, are avoided. Example: if you wish to buy a car, an Islamic bank might purchase the car on your behalf and resell it to you with a small, pre-agreed profit margin. This approach eliminates interest. Another key principle is the avoidance of uncertainty or excessive risk. Gharar. This means all transactions must be clear and transparent. For instance, an Islamic bank ensures that the terms of a home financing contract are fully understood by the customer, leaving no ambiguity. Contracts like mudarabah, profit sharing, and musharaka, partnership, are employed to foster shared responsibility and risk between the bank and its clients. This collaborative approach aligns financial success with mutual benefits. 2nd, principles of conventional banking. Conventional banks primarily aim to generate profits, often through interest-based loans. There are generally no ethical restrictions on profit sources, provided they comply with national laws. Example: for a car loan, a conventional bank lends you the required funds and charges interest on the amount over time. Conventional banks rely heavily on the concept of compounding interest. While this can yield significant profits for the bank, it may also result in substantial debt for customers if payments are delayed or mismanaged. Additionally, conventional banking practices often focus on individual customer creditworthiness. This can lead to varying loan terms based on credit scores, potentially limiting accessibility for low-income individuals. Ethical and professional conduct. Now, let's explore the ethical dimensions. Imagine a playground where everyone plays fairly. No cheating, no exploitation, and everyone's needs are considered. That's the ideal of Islamic banking. 1. Islamic banking. Fairness. Adl. Both the bank and its customers share risks and rewards. In a mudarabah, profit-sharing contract, for example, both parties agree on a fair division of profits. Transparency. Islamic banking contracts are straightforward about costs, risks, and rewards, reducing misunderstandings and fostering trust. Justice. Islamic banks avoid practices that exploit customers, such as excessive fees or penalties. Societal welfare. A significant portion of funds is channeled into activities that benefit society, such as affordable housing projects or funding small businesses. Trust and accountability. Islamic banking emphasizes the importance of trust between the bank and its clients. Regular audits by Sharia boards ensure compliance with ethical standards and provide customers with confidence in their financial decisions. Environmental sustainability. Increasingly, Islamic banks are funding projects that align with environmental stewardship, such as renewable energy initiatives, reinforcing their commitment to broader societal well-being. 2. Conventional banking. Conventional banks often prioritize shareholder interests, sometimes at the expense of customer welfare. This focus can result in less emphasis on long-term societal impact. Despite this, conventional banks have been making strides in corporate social responsibility. offering community development programs and sustainable investment options to appeal to socially conscious customers. Examples in the Malaysian context. Malaysia is a global pioneer in Islamic banking, and its financial landscape offers clear examples of the differences between the two systems. 1. Home financing. Islamic Bank uses murabaha, cost-plus financing, or ijarah, leasing principles. The bank buys the property and rents it to the customer until ownership is fully transferred. Conventional bank provides a loan with interest for purchasing the house. In Malaysia, Islamic home financing has gained popularity due to its ethical structure. For example, in a declining balance method under ijarah, the rental payment decreases over time as the customer's ownership share increases. 2. Savings accounts. Islamic savings accounts operate on principles like wadiyah, safekeeping, or mudarabah, profit sharing, allowing customers to earn profits from ethical investments. Conventional savings accounts pay interest on deposits without restrictions on how funds are invested. Many Malaysians prefer Islamic savings accounts for their transparency and the assurance that funds will not be invested in prohibited activities. For example, profits earned from halal industries like agriculture or technology often appeal to customers with ethical concerns. 3-point business financing: Islamic banks often use musyarakah partnership-based financing, where both the bank and the business share profits and risks. Conventional banks typically offer business loans with fixed interest rates, regardless of the business's performance. In Malaysia, Islamic banks support startups and small businesses by providing financing options that do not burden entrepreneurs with interest payments. This helps foster innovation and economic growth. Takaful, Islamic insurance. Takaful operates on mutual cooperation and risk sharing among participants. Policyholders contribute to a common fund, which is used to support members in need. Conventional insurance, on the other hand, involves risk transfer, where the insurer assumes the risk in exchange for premium payments. In Malaysia, Takaful has grown rapidly due to its alignment with Islamic values. Products like family Takaful plans cater to the needs of individuals seeking Sharia-compliant insurance solutions. Conclusion. In summary, Islamic banking and conventional banking are rooted in different philosophies and principles. Islamic banking emphasizes fairness, ethical conduct, and societal benefit, while conventional banking focuses on profit generation. In Malaysia, these distinct approaches provide consumers with options that align with their financial and ethical priorities. By understanding these differences, we can make more informed and socially responsible financial decisions. The growth of Islamic banking in Malaysia not only reflects its appeal to Muslims, but also its ability to address the universal demand for ethical financial practices. Whether it's home financing, savings accounts, or business funding, both systems have their strengths, allowing customers to choose what best suits their values and needs. Thank you for your attention, and I hope this discussion has provided clarity on this important topic.